If you inherited an IRA from a parent in the last few years, or you expect to in the near future, the IRS just pulled the rug out from under you, and your retirement account might be facing a tax bomb that nobody warned you about. For decades, if you inherited a retirement account, you could stretch your withdrawals over your entire lifetime. That meant decades of tax-deferred growth. It was called the Stretch IRA, and it was beautiful. But now, thanks to recent IRS rule changes and final regulations that went into effect just this year, most heirs over 65 are facing a brutal new one: 0-year clock, mandatory withdrawals, and confusion that could cost your family tens of thousands of dollars in unnecessary taxes. Today, I am going to walk you through exactly what changed, who it affects, and the critical steps you need to take right now if you are an heir over 65, so you don't accidentally lose a huge chunk of your inheritance to the IRS. Stay with me until the end because I am going to share the penalty that almost nobody knows about that is set to start hitting accounts in 2025, and this could directly impact your next tax bill. Let me start by telling you a quick story about a client I will call Margaret. Margaret is 72 years old. Her husband passed away a few years ago, and she lives comfortably on her Social Security and a small pension. Last year, her older brother passed away at 79, and he left her his traditional IRA worth about $300,000. Margaret was grieving, but she knew her brother wanted her to be taken care of. She assumed she could just leave the money in that account, let it keep growing tax-deferred, and just take out a little bit each year like she did with her own retirement accounts. She figured she had time. She figured the rules was simple. She was wrong. Margaret came to me 6 months after her brother's death, completely panicked because her accountant told her she might be forced to drain the entire account within 10 years, and that in some cases, she might have already missed a mandatory withdrawal. That missing withdrawal could trigger a 25% penalty on the amount she was supposed to take out. Margaret is not alone. Millions of Americans in our age group are inheriting IRAs from siblings, parents, and even aunts and uncles, and the rules have become a minefield. So, if you are a beneficiary of an IRA, or you are named on someone's account, you need to understand what has happened. Let us go back to the beginning. Before 2020, the rules were straightforward for most people. If you inherited an IRA from someone other than your spouse, you could set up what was called a stretch IRA. This allowed you to take required minimum distributions, or RMDs, based on your own life expectancy. If you were 65 and inherited an IRA, your life expectancy might be another 20 years or more, and you could spread those distributions and those tax bills over all those years. The account kept growing, you paid taxes slowly, and it was a wonderful wealth-building tool for middle-class families. But then Congress passed the Secure Act, which went into effect in 2020. The Secure Act killed the stretch IRA for most non-spouse beneficiaries. Suddenly, if you inherited an IRA, you were required to withdraw the entire balance by the end of the 10th year following the year of death. This became known as the 1-0-year rule. At first, many people and even financial professionals thought this was pretty simple. You don't have to take anything out for years 1 through 9, and then in year 10, you drain the whole account. You pay whatever taxes you owe, and you move on. This caused massive confusion because the IRS had not yet clarified whether you actually had to take money out during those first 9 years, or if you could just wait and take it all out in a lump sum at the very end. For several years, Financial advisors and accountants went back and forth on this. Many assume that if the original account owner had already started their own required minimum distributions before they died, then the beneficiary had to continue taking annual RMDs during the 10-year period based on the old stretch formula. Others assume the 10-year rule meant you could just wait, no annual payments required. The IRS stayed silent. They issued some early guidance suggesting that yes, annual payments might be required in certain cases, but then they waived penalties for missed RMDs in 2021, 2022, and 2023 because of the confusion. That grace period is now over. The IRS has released final regulations, and they have made the rules painfully clear. The confusion of the past few years is gone, and the consequences of getting this wrong are now real and enforceable. So, here is the critical distinction you must understand. It all depends on whether the person who left you the IRA died before or after their required beginning date for RMDs. This is usually age 73 for most people right now, though it was 72 for a period before the Secure II Act raised it. If the original account owner died before they reached their required beginning date, meaning they had not yet started taking their own RMDs, then you as the beneficiary are generally not required to take annual distributions during the 10-year period. You can let the entire account sit and grow tax-deferred, and then take it all out in year 10. This can be a powerful strategy if you want to minimize taxes in certain years, but you have to be very careful because taking out a massive lump sum in year 10 could push you into a much higher tax bracket, increase your Medicare premiums due to IRA surcharges, and cause a significant chunk of your Social Security benefits to become taxable. Waiting until the end is not always the smartest move, even if it is allowed. Now, here is where it directly affects our age group the most. If the original account owner died on or after their required beginning date, meaning they were already taking RMDs, then you, as the beneficiary, must continue taking annual RMDs based on your own life expectancy, or the deceased person's if they were older, during years 1 through 9. Then, whatever is left in year 10 must be fully withdrawn. This is the scenario that catches most people over 65 off guard, because many of us are inheriting from someone who was older than us who had definitely already started their RMDs. Think about it. If you inherit from an older sibling, a cousin, or a parent, they were likely in their late 70s or 80s. They were taking RMDs for years. This means the 10-year rule applies with annual RMDs required, and the IRS is now enforcing this without any more waivers. If you miss an annual RMD, the penalty is harsh. It used to be 50% of the amount you failed to take. That was reduced under Secure II to 25%, and if you correct it in a timely manner, it can be dropped to 10%. But that is still a 10% penalty on money you were supposed to take out, and you still have to take it out and pay the income tax on top of it. It is a penalty you absolutely do not want to pay. Let me give you another real-life scenario that illustrates the danger. John is 68 years old. He inherited a traditional IRA from his aunt who was 84 when she passed away in 2021. His aunt was taking RMDs. John, confused by the rules, moved the money into an inherited IRA, but he did not take any distributions in 2022, 2023, or 2024. He thought he had 10 years to do whatever he wanted. Because the IRS waived penalties through 2023, he dodged a bullet for those first few years, though he still should have been taking money out. Starting in 2025, the full rules are in effect. John must now calculate his missed 2024 RMD, take it immediately, file Form 5329 with the IRS, and request a waiver of the penalty, showing reasonable cause. The IRS has indicated they will look at these on a case-by-case basis, but there is no guarantee they will forgive the penalty now that the final regulations are published. Worse, he must take his 2025 RMD on time, or he will face the penalty without any reasonable cause argument. John's situation is not unique. It is incredibly common, and it is why you need to act now. So, what must you do if you are an heir over 65? First, determine the date the original account owner passed away and whether they were taking RMDs. Look at their age. If they were 73 or older, they were almost certainly taking RMDs, unless it was a Roth IRA, which we will talk about in a moment. Second, determine what year you are in relative to the 10-year clock. If the original owner passed away in 2020, your 10-year period ends the 31st of December 2030. If they passed away in 2024, you have until the 31st of December 2034. If you are already several years into this period and you have not taken a distribution, and the original owner was taking RMDs, you need to consult with a qualified tax professional immediately. You likely have missed RMDs, and you need to calculate them, take them out now, and file the appropriate penalty waiver request. Do not wait until the IRS sends you a notice. Being proactive shows reasonable cause and can save you from the penalty. Now, what about Roth IRAs? This is a very different and much happier story. If you inherit a Roth IRA, there are no required minimum distributions during your lifetime. Under the new rules, you still must drain the account by the end of the 10th year. But you do not have to take annual RMDs during years 1 through 9. And the best part is, those withdrawals are completely tax-free, as long as the original owner held the Roth for at least 5 years. This makes Roth IRAs an incredible legacy tool. If you are an heir of a Roth IRA, you can let that money compound tax-free for almost the entire decade, and then take it all out without paying a dime in taxes. This strategy is often overlooked, and many people make the mistake of taking money out of a Roth IRA too early when they don't need it, simply because they are panicked by the 10-year rule. You do not need to panic with a Roth. Let it grow. Use it strategically to avoid jumping into a higher tax bracket later. This is one of the few pieces of good news in the inherited IRA landscape. But there is a huge specific warning for married couples that many people overlook. The rules for spouses are completely different from non-spouse beneficiaries, and they are far more favorable, but they are not automatic. If you are a surviving spouse, you have options that nobody else has. You can roll your deceased spouse's IRA into your own name. By doing this, the account becomes yours completely. Your RMDs will be based on your own age, meaning if you are younger, you can delay RMDs longer and your life expectancy factor will be more favorable, meaning smaller withdrawals and lower taxes. Alternatively, you can treat the IRA as an inherited IRA. This is sometimes advantageous if you are under 59 and a half and need to take money out without paying the 10% early withdrawal penalty, because inherited IRA distributions are not subject to that penalty, even if you are younger than 59 and a half. Spouses also have the option to delay RMDs until the year the deceased spouse would have turned 73. These are crucial decisions that have major tax implications, and they are permanent. You cannot undo a rollover once it is done. If you are a surviving spouse, do not make a single move with that IRA until you have sat down with a financial planner or a tax professional who specializes in retirement accounts. I have seen too many surviving spouses roll an IRA into their own name without understanding that doing so meant they lost the ability to take penalty-free withdrawals before age 59 and a half. You need to know what you are giving up before you act. Another overlooked detail is the beneficiary form itself. This is the root cause of so many inheritance disasters. If the original account owner did not properly list a beneficiary, or if the beneficiary on file is deceased, the IRA could be forced into the estate. When an IRA goes through an estate, the 10-year rule often does not apply in the same way, and the payout period can be shortened to 5 years, or even require a full immediate distribution. This accelerates the tax bomb and gives you zero flexibility. If you are over 55 and you have not reviewed your own IRA beneficiaries in the last 2 years, please, I am begging you, go check them right now. Make sure they are updated, that you have contingent beneficiaries listed, and that the form reflects your current wishes. If you are on the other side, as the beneficiary, you must ensure the custodian properly titles the account as an inherited IRA. The titling must include the original owner's name, the date of death, and the fact that it is for the benefit of you, the beneficiary. If this is not done correctly, you could accidentally trigger a full taxable distribution that you cannot reverse. The IRS is extremely strict about this, and brokerage firms make clerical errors more often than you might think. Let us talk about the strategic withdrawal trap that happens specifically to our age group. When you are over 65, you are likely collecting Social Security. You might also be on Medicare. Taking large distributions from an inherited IRA can spike your modified adjusted gross income, or MAGI. This can trigger the Medicare IRMAA surcharge, which is an increase in your Part B and Part D premiums. This surcharge is based on your income from 2 years prior. A big distribution this year could raise your Medicare premiums significantly in 2 years. It can also make up to 85% of your Social Security benefits taxable. Many seniors do not realize that the tax on the inherited IRA is not just the ordinary income tax. It has a ripple effect that can increase taxes on your Social Security, increase your Medicare costs, and even push you into a higher tax bracket. This is why the idea of just letting the account sit and then draining it in year 10 is often a recipe for a tax disaster. A far better approach is to take systematic, calculated distributions each year that keep you under the next ARMA threshold and minimize your overall tax liability. This requires planning. It requires looking at your tax return and projecting your income for the next several years. If you inherit a 6-figure IRA, you absolutely must model out the tax implications of different withdrawal schedules. Now, there is one more twist that came out of the final IRS regulations that surprised a lot of professionals. There is a special rule that if the original account owner was already past their required beginning date, and you, as the beneficiary, are older than the original account owner, your annual RMDs are based on the longer of your life expectancy or the deceased person's life expectancy. In practice, this usually means you use the deceased person's remaining life expectancy because they were older. This results in slightly higher annual RMDs. It is a minor point, but it matters if you are 80 inheriting from a 5-year-old sibling. The formula is a bit more aggressive than you might assume. Do not try to calculate this yourself using a generic online calculator. You need to use the IRS single life expectancy table, and the rules for resetting that table after the first year are specific and easy to mess up. A mistake here means an incorrect RMD, and an incorrect RMD means a penalty. Let us come back to the 2025 penalty enforcement that I mentioned at the start. The IRS has made it clear that the penalty waiver years are over. They are now expecting full compliance. This means that if you are an heir who should have been taking RMDs and you have not, the clock is ticking. I recommend you work with a CPA or an enrolled agent to prepare a Form 5329 for each missed year and attach a reasonable cause statement explaining that you were confused by the constantly changing guidance. Many professionals are reporting that the IRS is accepting these waivers for 2024 and prior years, especially if you take the missed RMD immediately and document your efforts to become compliant. But you must act. Silence and inaction are not a strategy. We are at a point where I want to make sure you leave with absolute clarity. If you are a non-spouse heir of a traditional IRA, you almost certainly have a 10-year clock. If the person you inherited from died before they started RMDs, you can wait until year 10, but you should strategically plan your withdrawals to avoid a tax spike. If they died after they started RMDs, you must take annual RMDs starting the year after death, and failing to do so in 2024 or beyond will trigger penalties. If you are a spouse, you have the choice to roll the IRA into your own name or keep it as an inherited IRA, and this choice has profound tax consequences. If you inherited a Roth IRA, your withdrawals are tax-free, but you still must empty the account by year 10. The most important thing you can do right now is gather your paperwork. Find out exactly what type of account you inherited, when the original owner passed away, how old they were, and whether they were taking RMDs. Then, schedule a meeting with a tax professional who understands these rules. Do not rely on the brokerage firm to tell you what your RMD is. Many firms are still not calculating inherited IRA RMDs automatically, especially for the 10-year rule cases. They may send you a letter saying your RMD is 0 when in fact you have a legal obligation to take a distribution. The burden of compliance is entirely on you. This is not a situation where you can blame the bank if something goes wrong. I know this is heavy. I know that when you are grieving the loss of a loved one, the last thing you want to do is learn a new set of IRS regulations. But I also know that the loved one who left you that IRA wanted you to have that money. They saved it for you. They paid taxes on it or deferred taxes so that you could benefit. It is an act of love and responsibility to make sure you manage that inheritance wisely and do not lose a huge portion of it to unnecessary taxes and penalties. And do not forget to take care of your own planning while you are at it. Look at your own retirement accounts. Make sure your beneficiary forms are updated. Consider whether converting some of your traditional IRA to a Roth IRA over time might make sense to spare your own heirs this complexity. A Roth IRA gives your children or siblings that beautiful 0-year tax-free growth window. In fact, if you are charitably inclined, you might also look at naming a charity as a beneficiary of your traditional IRA, because charities pay no income tax on those distributions, and it can be a highly efficient way to leave a legacy without saddling your heirs with a tax burden. These are conversations worth having with your family. I want you to imagine it is a year from now. You have a clear plan. Your inherited IRA is properly set up. You know exactly how much you need to take out each year, and your tax bill is predictable and manageable. That peace of mind is possible, but only if you take action. This information is timely and critical, and there are going to be millions of seniors who miss this and end up learning the hard way through a penalty notice from the IRS. Please be the person who gets ahead of this. Thank you for spending this time with me. If you found this helpful and you want to make sure you never miss an update when the government changes the rules on our retirement money, please take a moment to like this video and subscribe to the channel. When you subscribe, you help this community grow, and you help more people in our age group protect what they have worked so hard to build. I would love to hear from you in the comments. Are you currently dealing with an inherited IRA? Did you know about the 10-year rule and the RMD requirement? Sharing your experience helps other people realize they are not alone in this. I read the comments and I use your questions to shape future videos. Thank you again for watching, and I will see you in the next one.